All right, get on with it.
All right, welcome everybody to our latest installment of our Bugle Notes podcast here at Reveille, where we sound off on the economic and investment topics that we believe our listeners and our clients are interested in hearing and learning more about. And so today I'm really pleased to be joined by other members of our investment committee, along with Patrick Hill, our managing partner down in our Reveille Ocala office. And Patrick is going to take us through his presentation on the economic crisis that we could potentially be facing here as a nation, all predicated on the level of debt that we have in this country, America's debt crisis. So, Patrick, thank you so much for being here today and joining us for this discussion.
All right. Well, thank you for having me. You know, it's interesting today in particular because I'm in Ocala, Florida. Christopher is down in the Villages, and we're all waiting on this massive hurricane to come in, right? And the media's putting on their scare presentations and letting you know it's coming. But if you watch the news, they're all standing on a beach somewhere in Florida, and it's nice, right? I mean, it's a smooth day. There's no breeze. The waves haven't really even kicked up yet. And so they're telling you that a storm is coming and you know it's happening and you can feel it, but it's not here yet. And that's about how I think most of us feel about the debt, right? You're standing at the base of a volcano and there's all kind of signs happening, but your own life is pretty good, right? You're paying your bills, your family's fine, your income's great. You look around, your neighbors are doing fine. And so we know something's coming, we feel it, but we don't really understand what it is because the numbers are so massive. So a long time ago, roughly 13 years ago, I came across the financial report of the United States government, and it was a 2010 version. And I read reports and I read financial reports typically as Ambien to put me to sleep at night. And that night I couldn't sleep because what I read in our own annual report was basically that our country was on a path for bankruptcy. And it wasn't hidden, it was admitted in the document that what we were pointed toward with our policies and our financial situation was unsustainable. That's actually the term that they used. And so I've been reading that document every year and getting more and more concerned to the point that I literally had no plans to retire because I was so afraid of what that meant for the markets, what it meant for my clients, what it meant for my family, that I thought I had to hold on to the ship, right? I had to keep steering things to get us through that crisis. Because at this point, I've been doing it 40 years and I've been through a lot of financial crises. I don't think any of them as bad as the one we're facing, if nothing changes. But that will, and I'm just going to tell you that feeling, though I have no plans to retire, clients who may be listening, none, that feeling changed when I met Nolan. When I met
Yep.
Nolan in Nashville, he started telling me about what this investment committee does to manage money. And it was like a light bulb coming on over my head going, this is the answer that I've been looking for from a financial standpoint.
We're talking about the Reveille rules-based investment discipline.
The Reveille rules-based investment discipline, though it was not set up for this event, I think it's in my 40 years of financial planning, it was set up perfectly for the storm that's coming, at least in my opinion. And that's how we got here. And so I'm so happy to be on here with the investment committee to go over this and to start talking about what is the debt crisis going to look like? How would we handle that? So I think we're in a really good spot, and I'm happy to do this podcast. And I'd like you not to take my word for it, right, guys? I don't want you to take my word for it. I want to go through the 2023 fiscal year version of the financial report of the United States government. Now, this book is 240 or so pages thick, right? And Christopher and I, we've both been through it with a fine-tooth comb, have dug through it, but we like to use the government's own words and the government's own numbers to prove the point. So don't take my word for it. Don't take the Democrats' word for it. Don't take the Republicans' word for it. I want you to see what the Treasury Department, the Office of Management and Budget says about what America's financial future looks like. So are we on the screen here? You can see
Yeah, we are. And I would just want to say a couple things to preface this, that all politicians have been culpable in the environment that we're in today, right? It doesn't matter if they're Republicans or Democrats, they've all participated in the financial condition of the United States getting to where it is today. And so we're not necessarily here to label one as good, one as bad. They're all equally responsible for this. The other thing I'll say, just to go back and reiterate something quickly on our rules-based investment discipline, is that process, as you mentioned, Patrick, it wasn't forged to, for a particular event that we saw on the horizon, but we recognize that there are challenges that happen regularly in the markets, to where the market is not always just going to go up, and there are going to be times where being in cash and sitting out the storm would be better than riding through it. And for what you believe is on the horizon, being able to potentially sidestep some of that, where it would take many, many years for some to recover, being able to exit the market, preserve capital during that time is going to give you an opportunity to be able to profit from that versus taking many years to recover.
Correct.
Yeah, let's jump in and let's go through and look at the data and see what the Treasury's saying.
All right, so we're going to start out of the, like I say, it's 240 pages, and we don't have time to go through all of it. But I'm going to turn to page 14 in this book. And 14 in the book is the government's financial position and condition. And so we're going to go through this chart. See if we're going to work here. There we go. So this is the government's financial position and condition. It's the management's discussion and analysis of America's financial. So if we were looking at this as an annual report or as a personal financial report, which many business owners, or if you have a commercial loan, you have to do every year, we're going to look at it and we're going to break it into 3 sections to make it a little bit easier. Do we all have clear view of this screen?
Yep.
Okay, so super. So first we're going to look at the top section, right, which is where our gross cost is. And we're going to first look at that very first top line. And I first want you to notice that we're talking up here. This is where our annual budget, right? What we're spending, what we're bringing in for revenue. And if you look at the very first number at the top, our gross cost, then we're going to break it down to the next section. Once we get past that, we're going to look at our assets. What does the government currently own? What are our liabilities? So if we were looking at this like a Charles Dickens story, right, a Christmas Carol, the first part up here would be the Ghost of Christmas Present. What's happening right now? How much are we spending? How much are we bringing in revenue? The middle section would be the ghost of our past, right? What have we done? What have we built up as far as debt goes? And then finally, the bottom section is our sustainability measures. And I want you to notice you switch from billions of dollars on the top down to trillions of dollars on the bottom. And that's because that's our future projections. So we don't even bother with billions when we talk about what does our financial future look like. We jumped right into a future of trillions of dollars. So to make it a little easier to read, we're going to break into each section. So first, a study of America's spending to revenue gap. And I want you to look at that top number for 2023, $7.6 trillion, almost 7.7 trillion. And it's hard to really explain to anybody, even for me, who's studied this for over a decade, to understand what $1 trillion is. Our country is spending, our gross cost, we're spending $1 billion, 7,661 times in a year, 638 billion a month, 147 billion a week, or $21 billion a day. In the 30 seconds it took to read this factoid, our country has on average spent another $7.3 million, which is a lot of money. to spend by anybody's measure. Now we have some revenue coming in to reduce that number, 539 billion, and that's not tax revenue. That's fees and charges and dock stamps and things along that line. But that brings, and then we have some accounting changes, and the accounting changes adjust 760 billion back up. So what we're left with is a total net cost that your government, my government, is spending almost $7.9 trillion a year. We bring in 4.4, almost 4.5 in tax revenue. That's total tax and some other unearned revenues. But that puts our net operating cost at a loss of $3.4 trillion. 3.4 trillion. Again, that's 1 billion more than we collected in revenue, right? That's 1 billion more than we collected in revenue, 3,470 times a year. In the 30 seconds it takes to go over this, we are spending another $3.3 million that we do not have. So
we're borrowing another $3.3 million every 30 seconds.
Every 30 seconds.
Wow.
It's not just that we have this pile of debt. I mean, just an unfathomable pile that we'll get to in a minute. It's just we are rapidly increasing the pace, right? So it's unfathomable how much we're spending. And then I don't know if you remember back to the state of the economy, the State of the Union back in February or March actually, and they said, well, our budget deficit for 2023 was roughly 1.7 billion, and that's because of some accounting adjustments. And so they actually claimed that, hey, our budget deficit only increased by 1.6 trillion, 1.7 trillion. But that number isn't the number you should be looking at. You should really be looking at the net operating cost, because that's the number that was actually added to our debt for the year. And how bad is the spending? So I want to get into a discussion on, is this a spending problem or is it a taxing problem, right? Because that's what we get from the Democrats. That's what we get from the Republicans. The Republicans say we spend too much, we have too much waste, right? If we can get rid of some government waste, we should be able to solve the problem. Democrats say we don't tax the rich. I'm telling you that my studies of this book and others, like I think Joe, was you who mentioned in our pre-talk, you talked about the Congressional Budget Office or the Committee for a Responsible Finance or something along that line. Those guys, I've studied their stuff also, but we've got the Trump tax cuts or the Tax Cuts and Jobs Act of 2017 set to expire at the end of 25. If these tax cuts are extended, major spending reductions would be required to balance our budget. And so if we wanted to balance our budget, by 2035, I think the number is, we would have to cut spending by 26% across the board. Now, let me ask you guys, if we cut government spending by 26% across the board, I'm talking Social Security, Medicare, the Defense Department, every bill, if we cut it by 26%, what would that do to the economy? And what do y'all think it would do to the markets?
Well, it would be very bad, that's for sure.
Yeah, it would be devastating, right?
So, Patrick, one of the things that our last podcast, we had Larry McDonald join us, and we were unpacking some of these similar ideas from the book that he just wrote. And so one of the issues that he cites in there twofold. First is this quote from Alexander Tytler, who is a Scottish historian, who said that a democracy is always temporary in nature. It simply cannot exist as a permanent form of government. A democracy will continue to exist up until the time that voters discover that they can vote themselves generous gifts from the public treasury. And so nobody really wants to cut the spigot off for themselves. So that's number one. That's the spending problem. Mm-hmm. The other piece on here that as you're, and I don't know if you're going to unpack these a little more independently, But one of the things that we cannot cut is the increase in interest expense on the national debt. And that's one of the things that Larry gets into more in his book, and I guess we can talk about more here later throughout the discussion, is that the Federal Reserve from March of 2022 until the middle of 2023 increased interest rates from 0 to 5.5% on the front end of the yield curve. Interest rates went up dramatically across the yield curve, all maturities. And what that translated to was a massive increase in interest expense for the federal government each year. And it was one thing to have, to have zero interest expense when we were in a zero interest rate environment and have 15 trillion, 20 trillion, even 25 trillion worth of debt. But when you get into the 30s and you go from 0 to 5% quickly, it's going to have ramifications, and we can't do anything to cut that expenditure out of the budget. But it probably is going to mean that the Federal Reserve, somewhere along the way, they're going to have to be more in cahoots with the federal government to bring interest expenses, or to bring interest rates down to where that interest expense could be more manageable.
Well, they can certainly try, but the
They
market
could certainly try.
the markets have a very large say in that.
Well, they would maybe for the longer maturities, right? And we can unpack that here in a minute. But the Fed can determine where they want short-term interest rates to be, and potentially, and this is one of the ideas that Larry gets into in the later part of his book, that one of the ultimate victims in this could be the U.S. dollar, because we really only have two paths maybe to try to rectify this issue. Path one is austerity. Path two is forever inflation, where the dollar is the ultimate victim and depreciates materially in value. But let's keep going here with this idea around the spending cuts.
Yeah, and we'll cover some of that, right? We'll cover some of that. But my point with this particular chart is I want you to look at it, right? So you can cut 26% across the board, right? But hey, if you've looked around the world, China's rattling its swords and Russia's invading sovereign nations. And so do you really want to cut defense, or would you cut veterans? Probably not. And if you don't cut them, now everybody else, every other program has to be cut 33%. But you know who doesn't like cuts? Seniors getting Social Security. They don't want to take a pay cut. If you don't cut them, now everything else has to be cut 51%. And so if you protect veterans, Social Security, Medicare, and defense, all other programs would have to be cut by 85%. Everything. It's not possible. We're just not in a position as a nation. So we can't, as fiscal conservatives, it's very difficult to make the argument by itself that, hey, we should just cut spending. There's not enough cutting that can be done without creating incredible damage to an already weak economy.
And Patrick, this is just purely to get to a place to where we're taking in as much as we're spending.
Right. It's got nothing to do with
nothing of the current debt, correct?
Correct. Nothing to do with current debt. And this, by the way, is from the Committee for Responsible Federal Budget. So it's a nonpartisan group. These aren't my numbers. It's coming from 10 and 30-year baselines adjusted for current tax policy and our current tax cuts. So
that would mean, I think you hit this on that last slide, that this is already factoring in the prospect that the tax cuts from 2017 roll off, and ordinary income taxes, estate taxes move higher and stay higher permanently beginning in 2026.
Yeah, this chart is actually saying that the current tax cuts are extended.
Oh,
right?
Okay.
This is saying the current tax cuts are extended.
Okay.
I got to tell you, even if those tax cuts go away, it really doesn't look a whole lot better, right? Your number for cut all spending drops to 78% or 79%. It still doesn't work. right? But we've got a really big debate coming up on this. And, you know, shortly after the election, because it ends in 25. But how do you do that, right? If you ever want to balance the budget, it's just not going to happen by sheer cuts alone. So let's go back now and move to the next section. So I've covered, unless y'all have anything else to say on the ungodly amount of spending that this nation is doing. We're good?
Yeah, no, I think you're good. Just keep on going, buddy. This is
Okay.
insightful.
So this is the middle section, right? And this is our current assets and current debt. So we're going to flip through these, and cash or other monetary assets, guys, this $922 billion, it jumps all over the place. It's cash on hand at the moment, money that hasn't been spent. So that'll jump all over. I'm not going to spend much time up here. Inventory related property, that's kind of our stuff, right? These are assets that the federal government has. Click to the next one, loans receivable. Any guesses on loans receivable? What the almost $1.7 trillion in money owed to the U.S. government? Any idea on what 90% of that is?
They're just delayed tax payments.
Student loans.
90% of it, you think, really?
No, it is 90%.
I
Wow.
thought we were forgiving those though. Why are those in our balance sheet?
That's the point. So that number jumps all over the place also. I mean, it'll be one number. Supreme Court will make a decision. It'll be another number, right? So, you know, that could very easily move from here down to the debt portion, which is a pretty good flip when we start forgiving that. So it changes the numbers a lot. General plant and equipment, that general property, plant and equipment, that's 1.2 trillion. Now that's a very inaccurate number, and it's actually very low. Because when we talk about general plant, property, equipment, that's all the property. That's our national parks, right?
Right.
Our mountains, our land, and all of that is on the books at what they originally paid for it. Nowhere near market value. But it's also there was a paper that came out, and I'm sorry, I can't remember the name, but it came out, I think, before Trump was elected the first time, and it said that if the U.S. government sold off all of its land, that it would pay down the debt. It would completely pay down the debt. And both parties have used that to be able to go, well, then the problem's not that big.
Right.
But when economists got in and started studying that document, they said, well, sure, if you took the entire value of the property with all the minerals and none of the expenses, all the oil, minerals, all the net worth you could get off of that property, and if you pulled all of that out, right, and you added expenses to it, it's nowhere near what it's just not nearly enough. Not to mention the fire sale you would have on prices if the government started selling off their assets to pay down debt. So that's a very low number.
I mean, it seems a little nonsensical to even talk about the idea of, you know, selling a national park to China. It just,
yeah, or you know,
Right.
or giving naming rights to some of our institutions, you know, the White House Waffle House or like
or
that.
also, you know, if you go back and look at, well, what's the value of, let's say, the oil in a bunch of the national land? Well, I mean, that's a political hot potato right there.
sure.
To say, hey, we're going to go, you know, sell a bunch of land to some oil companies so they can start to, you know, pull that oil out. And that might be worth a lot of money, but that would be probably a non-starter politically.
Yeah, I mean, they're already doing it right by selling off leases, and then they don't let, you know, selling off lease rights to the minerals or to the
Right.
natural resources, and then they, you know, you end up in court fighting for it. So the value's not there. It's just not there. But, you know, you add all that together and it's $5.4 trillion.
Hey, Patrick, let me ask one question before you move on from assets. What about gold reserves? Is that factored in here somewhere?
That is factored in there. That is under general properties, equipment, inventory. That's all, it's all tucked in there.
Okay.
At least according to this document, right? I can't, you know,
Sure.
right?
Okay.
So yeah, but great question. And actually I'll dig a little deeper into that, but everything is supposed to be in this document. And literally they go to every department of the U.S. government, and this is piecing it all together. So this is considered, in the book, it actually on page 2 or 3, they say it's very important for all politicians, all citizens to have a clear understanding and know what's in here. But, and I'm pretty savvy about this stuff, but until 2011, I had no idea this even existed. Right. And you don't hear every year the government coming out and saying, or the media coming out talking about this document. and anybody can get it by Googling it, right? It's not hard to find. I actually got my first copy from the Library of Congress. Had a friend give it to me, so led me on a long journey. So the next section, right, we're moving into debt. So we've talked about our assets, and I think we all agree you can't sell that stuff off, right? If you do, what kind of a fire sale would happen? What would that do to the economy if suddenly the U.S. government had to sell off assets?
Well, I
to
don't.
pay down debt?
They wouldn't be selling it all at one time, right? They know that they couldn't do that, but that they would piecemeal it out over generations, likely is the way that it would unfold.
Yeah, but not quickly enough to pay down any serious debt. I mean, that's the point, right? Is that, yeah, you're right. Could they sell off pieces or start doing leases, or give more leeway to the oil companies and to the lithium companies, to all those groups? Sure. Will it happen?
Well,
I don't know.
here's one thing that I'll just say on that real quickly, because Chad brought up how it's a political football around the oil companies, the energy companies going in and trying to mine for energy on some of these federal lands. The green energy movement, the electrification that a lot of progressives want to see us move towards as a society, requires an immense amount of energy. And that's something we can unpack on a different podcast. But it is far more energy than we are currently producing. That energy is going to have to come from somewhere. And so I wouldn't be surprised to see if they would sing a different tune on some of this as we would transition from where we are now to some greener pastures going forward. So but let's keep moving on here.
Yeah. So first, let's start with the federal debt and interest payable, right? So this is current interest that is already accrued, right? That we already have to pay out. This isn't forward interest. This is just what we owe today. And the federal debt and interest payable is $26.3 trillion. And I want you to look, that's higher than 2022, right? 2022 was 24 trillion. Now it's 26 trillion. We're adding more than 2 trillion for fiscal year 2024 that just ended September 30th, right? So we'll add another 2 trillion before, just from our budget spending, right? Just from overspending. We add in the federal benefits payable, that's 14 trillion, 14.3. Then the famous other, which is another 2.2 trillion from other debts that we owe or other liabilities. So when you see, if you've seen the U.S. debt clock, that ongoing clock that you can see in Times Square, and if you go to usdebtclock.org, you're going to see a lot lower number than the number of total liabilities, which is basically $43 trillion. 43 trillion. And that's a much higher number than you've probably seen. And again, I'm not, this isn't my number. This is the U.S. Treasury's number. 43 trillion. I will tell you that currently that number is a lot closer to 45 trillion. Matter of fact, I think when we get the next document, which won't be till February, that will be a $45+ trillion total liabilities. And that is the difference. The number that you're seeing on that debt clock is just debt. It doesn't include other liabilities that the U.S. government is already responsible for paying. And so more likely the government will talk about 37 trillion, 37.5, but that's simply saying, hey, look, if we sold all this stuff up top, right, we can take the 5.4 trillion that we own, like it's a family business, right? We can just sell all that off and we really only owe 37 trillion. That's our net worth. Not an accurate number if you can't sell any of this stuff in any reasonable amount of time. So this is a pretty big number, right? $37 trillion. So how does all this project out, right? What does the government say? This is where this is leading us. This budget deficits, this deficit spending, the $42 trillion in debt, $43 trillion in debt, leaves us at a net position of 37.5. And that takes us down to, again, a total of U.S. national debt, $43 trillion. And I want you to know that $43 trillion is so large. It is bigger than the gross domestic product of Germany, China, Japan, India, the United Kingdom, France, Russia, Canada, and Italy combined. Combined. That's a massive number. So we owe more money than all of these countries generate in a year. Our budget that we're spending, just our budget, is greater than the GDP of the United Kingdom and France combined. So actually just our debt, our budget deficit is greater than two of them. So these are big numbers that maybe will open people's eyes to this is out of hand and it's unsustainable. Any questions on that? I mean, other than picking your jaws up off the ground?
No, I did see, I do remember this morning in the New York Times article on the topic, they had a congressman, picture of a congressman, and he's wearing a little badge on his jacket that I guess it's a real-time ticking clock of the federal debt. And I remember that it was clicking by 35 million. So I guess they're,
Trillion.
so using that lower number.
Yeah, well, what they're using is they're not using other obligations, right? They're first taking the other number, right? They're taking the debt that we owe to the public and the internal debt between different government, what we owe Social Security, what we owe Medicare, what different agencies owe each other, right? Which all comes back to the taxpayer. The taxpayer owns it. So they're using a lower number, but they're not using the other, right? That other category, nor are they using the other obligations that we have, the other liabilities that the federal government has. But really, whether you're talking about 34 trillion or 43 trillion, they're just unsustainable at the pace that they're growing, right? So we take those numbers and we say, well, what does that mean for our future? What is the government telling us that's going to happen based on where we are right now? Now, these projections, by the way, even to something you said earlier, these projections, they assume that the tax cuts go away at the end of 2025. So they assume that those tax cuts, so that payroll taxes, not payroll taxes, but everything else is going to go up, right? All tax brackets are going to increase. The estate tax is going to become a massive issue again. And so assuming those tax cuts go away, which will be one of the biggest tax increases in history, and I'm sure they won't all go away. There'll be some debate, but some of them probably will. So let's look at what they're projecting over the next, now this is 75 years, but I'll get into some of the 30-year numbers and they won't make you feel any better. So this is Social Security. They're saying over the next 75 years, on top of the debt we just looked at, we're going to add another 25.2 trillion. And that means the money that we're collecting in payroll taxes, right, for Social Security, under current projections, over 75 years is going to add another $25 trillion to our already unbelievable debt load. Medicare is worse. Actually, I can click some buttons for you. Medicare is worse at $53 trillion. Again, some other expenses, $1 billion. So that's adding $78 trillion. $78 trillion more. That's adding to our debt pile that we currently have. Anybody think that's sustainable?
Well, we definitely know it's not, right? I mean, the fact that we're just trying to wrap our heads around the extent of our current federal debt and the idea that we could add almost another 80 trillion worth of unfunded liabilities, right? On top of that, how is that going to get paid for? And, you probably can't raise taxes enough to be able to pay for that. It reminds me, this is a number of years ago, probably 5 or 6 years ago. I was listening to a webinar that Jeffrey Gunlock, who's the head guy at Double Line, he's on CNBC all the time, brilliant guy, bond manager. And of course, the bond managers are always couched as being just generally pessimistic. But he was opining, somebody had asked him a question about gold and where's gold headed? And he was referencing how we've got this massive unfunded liability for the U.S. government. And he said, you know, we've got two choices. You know, there's going to be a choice that the U.S. government's going to have as to whether or not they're going to default on some of these obligations in terms of we're not going to pay them. And so that money is not going to get spent. It's not going to get borrowed, or they're going to pay it. And so he said, as far as it translated to what's potentially the future of gold and where the price of gold's going, again, this is 4 or 5 years ago. He said, if they default on those payments, then it could stay where it is, you know, maybe even go down a little bit. He said, if they decide that they're going to pay them, they're going to have to print the money to pay for it. He said, you pick a number. You pick a number of what it's going to be, and that's what it's going to be, because the US dollar is going to fall flat on its face if we end up with just a massive supply of new dollars out there to be able to try to pay for these benefits.
Well, let me, you know, the question I ask looking at this is, at some point, you've got to get to a place to where you don't have a willing buyer for this debt anymore, or you have to pay a higher rate to make it attractive, right? Which
Correct.
perpetuates the, you know, problem of interest payments on the debt.
So
Well, we're already headed that route. We have China and Russia. They're already looking at US dollar alternatives.
Yep.
Yeah, there
So
are,
this
those
is-
are signs, right? Those are all, so you think about, personally, I don't believe Bitcoin would be much of a thing if it weren't for worry about how much money we're printing. Certainly the reserve currency of other nations, it's because of worries about the US currency, worries about how much we're printing. So the signs are there, right? I mean, if you're standing at the base of that volcano, there's signs that we've got issues. And as a nation, we haven't addressed them.
So some of these things are Larry unpacks in his book. So I say one of the things that he writes here when he's talking about the potential future decline in the US dollar, and he unpacks all the way from, you know, the petrodollars and everything out there. You know, but what are we going to do as it relates to all of this debt, and how are we going to move forward with it? He says, in the long run, one option might be to resort to yield curve control, which is the final stage in the QE cycle. Ironically, this would be, this again would be a policy tool adopted from the Bank of Japan. The Fed will have to control rates by buying more bonds, and those bonds will be held at a fixed rate level of, say, 5%, obviously higher than where we are right now, or somewhere near there, because the natural buyer of that debt, as you're mentioning, they're not going to step up and buy it at 3%, 4%. But the Fed's going to have to say, we're going to buy it at 5%, inflation be damned. So that means more liquidity that could inflate another bubble, but it will likely exert more downward pressure on the US dollar. So it kind of goes back to one of the things that we mentioned earlier, that there's only one of two ways out of this. And it's either you choose a future path of austerity, or you choose a future path of inflation. But the roads, the roads are diverging in front of us very quickly here.
Yeah, we're losing options.
But you
We're
go back
definitely
to-
out of options.
You go back to World War II and that debt to GDP ratio in excess of 100%. And you look at how we came out of that and normalized our debt to GDP ratio. And a lot of it is attributed to, hey, we balanced the budget, we cut our spending, we increased tax revenue. But in large part, the majority of that concentration of the ratio was inflation. You made that past debt irrelevant.
Yep.
Mhm.
So-
And we did see a very large economic boom as well, coming out of that. And so that's the way that one of the ways that you can try to deal with inflation, outside of defaulting on it, trying to inflate your way out, you can potentially grow your way out of it. That's the nirvana option everyone would love, where maybe you don't have to cut the existing spending on programs, so nobody has to feel the pinch there. But where is that economic growth going to come from? It would be great if we got it, but it's going to have to be a massive amount of growth to try to bring that ratio back down to what we would consider to be a manageable level.
Yeah.
Patrick, let me ask you a question as it relates to inflation. So, obviously the federal government go out and print money till the cows come home, and, we could have runaway inflation, but how much of what the US government spends today is indexed to inflation in some way?
Social Security, right?
Yeah, no, that's the biggest component.
Yeah,
Medicare?
this chart, this 75-year gap is all, there is an inflation number in there. And they have it dropping. They have it a little bit raised from where it was a few years ago. And going forward, these projections have had a lot of manipulation, right? They've had a lot of manipulation. Because you remember, you're making a 75-year projection based on certain accounting numbers. And, the first part is on, hey, what are we spending? What are we projecting in revenue, right? And that 78.4 trillion is the gap, right, on our long-term. I mean, really, if you look at this, if we look over the next 30 years or so, and I've seen various numbers from various places and various economists, but it would tell you that somewhere between 80% and 97% of all of our budget deficits over the next 30 years come from Social Security and Medicare. And again, being led, it's a massive number.
Yeah.
And it's all based on a very low inflation rate, right? A very low inflation rate not necessarily compared to what we experienced for the last 20 years, but I think 22 gives us a lot clearer picture of what our inflation rates are.
2022.
2022, yes.
Yeah.
2022.
So on that, I want to unpack this idea, right? Because we want to talk about maybe the potential ramifications. And here's one of the big differences that could potentially be on the horizon. If the debt of the United States government is no longer held in the high esteem that it once was, that for 40 years, right, from the early 1980s when interest rates were peaking out and inflation was very high, inflation and interest rates were largely declining for 40 years until 2022. Patrick, for the entirety of your career, interest rates were in a downward path, a downward trajectory. That meant that bond prices were just edging up a little bit every year. And that's why the entire financial services industry, the investment management industry, bought in to this narrative, this idea that adding bonds to your portfolio helps to de-risk your overall portfolio, because bonds were going up in value for 40 years. And even though stocks had periods of time where they would take big dips, the bond market would provide some buffer. But if we are moving into a world where the trajectory and the path of interest rates is no longer down, but that it's higher, if the next 30 to 40 years interest rates are moving from zero back up to some level, don't know exactly where they're going, then that means that on a more secular path, bonds are going to be losers in your portfolio. The prices of bonds are going to come down, and they're no longer going to offer the diversification or the buffer to the stock market. And so what we saw in 2022 where both stocks and bonds were down double digits in the same year. First time I think we have that record of that happening at the same time in modern history. That could become more of a norm. And that is something that would completely disrupt the way that our industry does business. The passive nature of the way that trillions of dollars are presently allocated. They believe that asset allocation alone is sufficient to help manage risk, and they may have a rude awakening coming.
Sure. Yeah. Let me throw this out though as well. It's just a kind of the contrary view to all that we've been saying thus far. And that is this. And by the way, obviously we're all on the same page about the the ominous future that lies ahead, because these numbers are so staggering. But yet we've been talking about, we meaning many of us in this industry, for decades now, this issue. And of course, it's just continuing to get larger. But the ramifications of the amount of debt we have and the inevitable path that's going to lead to, of really the only viable way to get out of this is going to be to print our way out of it, which will have dire consequences for the dollar. And of course, we all have those conversations with a lot of people and clients about, well, does that mean that the US dollar just goes away? So shouldn't we therefore buy gold or fill in the
I'd
blank,
argue I
whatever
don't
else?
even think it's possible, honestly.
Well, but in the meantime, between now and that inevitable, horrible future when the dollar loses its reserve currency status and something else fills in the gap, what really is I get on a daily basis more at work is, like, why does the dollar still have value? Even though we all know, and many other people in the world, around the world, know these numbers, why does the dollar still have value? Why does it still have a demand? And I argue between now and some point in the future, whenever that is, it still comes back to, it's about having the best house in a bad neighborhood.
Correct.
Right. I mean, yes, our situation financially, fiscally, at the federal level is dire, but arguably so are many other sovereign nations that are world leaders and developed countries, and even emerging market countries are also
Chet,
dire.
I would say that, yeah, it could be we're the best house in a bad neighborhood. The other side of it could be that we have been the world superpower since the end of World War II.
Yep, for sure.
And we have made deals with the Saudis along the way to say, look, we have an insatiable demand for energy here in this country, and the world has an insatiable demand for energy. We need the oil that the Saudis have. We're going to be a buyer of that oil. We need you to produce that oil, and we need all of those commodity contracts to be settled in US dollars.
Sure.
There is a natural demand for US dollars. In exchange, not only are we going to buy your product, you're going to become very wealthy. We're also going to provide you with security to be able to do that. This is one of the ideas that Larry unpacks in his book. And so that's been the way that it's been for many, many years, 50 years, 60.
And then you add, and you add the similar situation with China, right? We have an insatiable demand for cheap products. Let's do a little swap. You buy our debt, we'll buy your stuff. So we're doing that all over the world over many, many, I guess, almost now generations, right?
Yep.
And it's accumulated to what it has. So, but what's interesting though, I think on the flip side, and then I'll put it back to Patrick, is, and I saw this at this issue came up at a conference I was at in New York a couple of weeks ago, and there was an unpacking of some of the similar concepts. But one of the things that was pointed out, which I think is a good point, a feather in the US's cap, is another driver of the demand for dollars is the fact that the US is also not only the kind of been the leader of the free world, so to speak, in many regards, and militarily, that's for sure, but also in terms of innovation, right? Even though we've been offshoring manufacturing for a lot of, for decades now, we've still led the charge and still today lead the charge in venture capital funding and in technology and healthcare innovation. And so as long as that's true, we've got an edge there, and there's a demand for US related, IP, dollars, et cetera, et cetera. And so
Yeah, I know Patrick may have stripped it out of this particular review, but I've seen some other elements of his presentation where he talks about the demographics of the United
that's in here.
States, right? And other countries, that, Chad, I think what you're saying has been 100% true without equivocation. But we know that there are a lot of very smart, innovative people who may have even been educated in the United States that have returned to their home countries of China, India, you name it, where they will have the ability to innovate, and their demographics are maybe better suited for
Sure.
economic growth than ours.
India's
So,
a big one there. India.
Oh,
India, yeah. Let's go back to this, Patrick. So let's kind of finish this slide out. We got $78.5 trillion worth of unfunded liabilities, principally from these two large programs.
That's correct. And so if you go down to the bottom, the bottom two numbers, let me get back over here. So total federal we're going to look at as a percent of GDP, right? So for the next 75 years, they're projecting that we're going to spend 4.5% more of our gross domestic product than we are projected to bring in revenue. And anybody know latest ratings on what America's GDP is? 28.
The latest number, you mean?
Yeah.
Sorry, value? 20
Yeah,
something?
I think our GDP is like 28 trillion.
28, yeah, 28 trillion.
Yeah, somewhere along that line. So 4.5% of that rising number over time. I do want to point out, however, it's actually worse than this, and I'm going to show it on a couple of slides. So this is a bad number, right? 78, 73 trillion, they're massive numbers. Well, the government wanted to prevent that GDP number from being over 4.5%. They don't want to rise that quickly. So they didn't make any change of projections, or how do we do that? How do we fix that? This note, number 2, to prevent the debt to GDP ratio from rising over the next 75 years, a combination of non-interest spending reductions and receipt increases that amount to 4.4% of GDP on average is needed. What does that mean? What do you guys think that means? This means this document, the Treasury Department is saying, hey, the number isn't 4.5%, it's 9%. But we had to adjust it because the numbers would have been too bad. Like 78 trillion is not bad enough. So what we're going to do is 100+ trillion. We're going to say, oh, well, let's change our projections. We're going to bring in extra revenue and we're going to reduce our spending. And so they're betting Congress is going to make a change with the number you're already looking at.
They've got a great track record.
Well, and we don't have time today, but I could go in and show you every year for the last 10 years. If you go back and you look at the projections 10 years previous, they were always off on the amount of revenue that we're going to collect. This book and the Congressional Budget Office always aim too high for revenue collected, and they always aim too low for how much we're spending. So
Patrick, let me clarify. Are you saying that the assumption that the target that they're outlining here is over the next 75 years, that they don't want the debt to GDP to go above where it is now?
Above 4.5% per year.
Okay,
In other words, increasing at a rate of 4.5% per year of GDP. Our debt increasing at that level. That fiscal gap, right? That spending gap. But then to get to that 4.5%, they had to throw in and make up some random numbers to make it look like that.
So they're saying we have to grow at a linear rate at 4.4% each year just to be at 4.5% in the hole.
Correct. Yeah.
And so, and as mature as our economy is, even in a good year now for economic growth, which should be expected, law of large numbers, maybe we can grow at 2.5% to 3%.
When was
maybe
the
a
last
year.
time we grew at 4.4% on a recurring basis?
Yeah. So, and I want to go back to what, Chad, I think it was, you said a minute ago, the hope that we can grow our way out of this problem. How do you grow your way out of a problem that's roughly 10% of GDP? Right?
Yeah.
I mean, how do you grow your way out of that? Now, I will say that I do not view, so when we talk about China and we talk about India, right? We talk about these other nations, and we'll get into some here talking about the baby boom generation and what it's caused, right? But there aren't other really large developed countries that are in a whole lot better shape. Because let me tell you, China, if you look at the demographics of China, you think America's are bad? China's are a disaster.
Mm-hmm.
You want to know why, my opinion, just my opinion, why they're going after Taiwan, why they went after Hong Kong? Because last year they were passed as the largest country in the world population. They're no longer the biggest country. India is.
Yep.
India's projections are to continue to increase. China is expected in the next 20 years. They're right now 1.4 billion people. They're projected to be under $1 billion within 20 years.
Under a
Under a
billion
billion people, you mean?
Yeah, people. Yeah, excuse me, people. From the CIA World Fact Book is projecting that their population is so old, so aged, that they clearly expect to be below 1 billion people within 20 years. And they have no safety net for their seniors, but their children, right? But their families, which are now much smaller. They're just not growing as fast as India, which is why I think Chris said a minute ago, India might win. Well, India might win if they clean this, a very corrupt government, corrupt economic system. You have to pay everybody off to get anything. This is not me. I'm telling people who are living there, who still live there. I have a lot of Indian clients. They tell me the same thing, is that it's a very corrupt society. And so it's very hard to put commercial dollars, right, to invest in India if you want to have any faith in your returns. So, but if India could clean up their situation, they would be in the best position to be the leader of the next millennia, right?
Mhm.
I mean, they're in the spot from a population standpoint. Let me move along a little bit so that we keep going. So add those numbers together, right? You take the $78 trillion projected debt, add in our current debt of 35 trillion and liabilities. And so we have a total projected debt over the next 75 years of 123 trillion. I think we'd all agree that's just a ridiculous number. But it's worse than that, because what do these numbers leave out? Have you noticed what we haven't talked about yet?
Unfunded liabilities.
No.
Yeah.
Can it get worse? No, we don't have those. Look at this line down here. What does this say right here? Total federal non-interest net expenditures. We haven't included the cost of the debt yet. So there's no interest expenses in this number other than interest that's already accrued. So this number does not include any interest spending.
Interest on the unfunded liabilities.
Interest on the debt, on the unfunded, interest on this number, right? Interest on the 42 trillion. Their projections aren't including, this is non-interest spending, net expenditures of $73 trillion going forward.
Wow.
Their words, non-interest net expenditures. Now, to use our term, is that a wake-up call?
Well,
Yeah.
I mean, that's one of those things, it's like an error by omission.
Yep. So there it is. I've just kind of blew the line up so you can see it. Total federal non-interest net expenditures of $73.2 trillion. We still have not discussed. We kind of mentioned it in our discussion. What's interest going to do to that? I was sitting here trying not to laugh because I knew this was coming, right? It's a bad number. So this chart is in the book. It's in this book. It's chart 5. I can't remember the page that it's on, but I can find it for you. So I want you to look at these projections as we screen through this. So total receipts is the black line. I've highlighted in green. Notice this is the current projections. It's relatively flat, right? This is going forward the next 75 years. That's a relatively flat number. Now, this is a percent of GDP, right? So it's based upon what we're growing. Total non-interest spending. So this is all spending that they're currently projecting, right? Including Social Security, including Medicaid, Medicare, defense spending. This includes everything. This next number, which was not in that $75 trillion chart, that's where we start adding in the interest.
So,
Again,
okay, so
it's in
can I-
here.
Patrick, can I ask a question? So, I have 2 questions about the chart you got right here. So one is, I noticed that the Medicare, up to this point, Medicare is below Social Security, right?
Correct.
But if you go back to your previous slide,
Page
you don't mind.
170, by the way.
okay, that previous slide where it showed, can you go back to that? It showed the trillions? The previous one? That one. Right there. So Medicare, this is projected sustainability measure. Medicare is double Social Security right there.
Yep.
Okay. Which is ominous. But up to this point, based on the chart you just displayed, that's not been the case, right? It's been, Medicare's been less. So the implied assumption is that it's accelerating dramatically beyond Social Security in the future.
I guess because there's more tax dollars that come in specifically for Social Security payments versus Medicare.
Okay.
Right. So
okay.
That is the answer, right? I mean,
So, okay, so that clarifies that. Now, the other question I had is back on what you're talking about interest. So up to this point, the interest expense, even though we've had this debt for a while, we've been accumulating in a more accelerated manner over the last, let's say 10, 15 years, right? But we've had the debt for a while. But up to this point, the interest expense hasn't really been overly problematic for us.
well,
because rates have been so low and they've been
because rates are
declining.
zero, right? I
Right.
mean, rates have been low. It has not been a problem. And the thing to keep in mind is this gap that you're looking at here, right? This net interest gap. Keep in mind that that's based on about a 3.5% number.
Yeah, that was my question.
3.25 long term.
There's
And,
no
and
way.
so if that's 3.25 and you're having, I can't remember who said it here, but someone said just a moment ago that, eventually the markets are going to wake up. And while the Fed may be able to control short-term rates, they will not be able to control long-term rates. And
Right.
even if they can control short-term rates, if the markets don't react, if the markets don't buy them, they'll have to make them more favorable terms. They'll have to push that rate up.
Well, that's where they talk about they could resort to yield curve control, which is what the Japanese central bank did, where
Right.
they can buy as much of the debt as they need to, but the victim there is the currency.
Right.
The value of the currency plummets in
Yeah.
that scenario. One thing that I'll say, just kind of rewinding here a little bit, kind of going back to this idea that for decades, interest rates were falling, rates were very low from the time of the financial crisis when interest rates went to zero in late 2008. And we really stayed in that zero interest rate policy regime for many, many years, is when we saw massive expansions in the federal debt because they were able to do so and it not show up as any sort of a meaningful budget line when the cost of carrying that was zero. Now, go back to COVID, when the economy, we decided to shut it down, and there were massive stimulus efforts that happened there. That was the lowest that we saw interest rates ever fall to here. And, there were some interest rates even certainly overseas, but even some here domestically, where interest rates were negative. They were negative on the very short end because there was such an insatiable demand for those particular treasury notes. But even long-term treasury bonds, I think the 30-year US Treasury traded down to about a 1% yield, maybe 1.5%. It was extremely low.
I thought 30-year got down to about 0.5%. Am I wrong about that?
I know the 10-year did. I think the 10-year traded down to about 0.5%, maybe 70 basis points. But I don't think the 30-year ever got quite to that level. But it was extremely low. And I remember Steve Mnuchin, who was Trump's Treasury Secretary, when that was happening, and there are all these stimulus efforts that were being floated at the time. This was in March and April of 2020, when there was still just massive uncertainty of what was going on. He floated this idea that the US Treasury, I don't know if ever in their history, but certainly in a really long time, they haven't floated a 50-year bond or a 100-year bond. Other countries had. He floated that idea, and then he also said, look, we should try to refinance our national debt because the weighted average maturity of our national debt at the time was like 3 years, because it was short end of the curve, very inexpensive, practically zero. He said we should refinance this debt from zero with a 3-year maturity to 30 years, 50 years, whatever the market will give us in terms of duration, at 1.5, 2, 2.5, whatever it was going to be, because there was an incredible demand for treasuries at the time. He said we should do that and lock those rates in. And he was chastised by the left at the time, saying, does he not understand the nature of deficits? It would balloon the interest expense by many times, going from practically zero to 1.5, 2, whatever. And of course, we can look back historically now and go, how could they not have done that? But it was a political football at the time of it's gonna explode the deficit. It's gonna explode the interest expense by a factor of 10 if we do that, moving from almost the zero bound to just 1.5 or 2. But that would have been the moment, right, where potentially the direction of this chart changes.
I do think it's important to note on this chart that we're not looking at dollar cost. We're comparing this to our GDP. And so we've gone from comparing, all right, what is our existing debt to GDP, to this is what our annual budget to GDP is. And we're getting to a point where, I mean, you've got that net interest spread in there, because not necessarily because of rates, but because we've got over 30, we've more than doubled our existing debt over the last decade.
Well, it's interesting too, if you look at where the debt's being issued right now, so much of it is on the short end of the curve. And, Janet Yellen is playing a really kind of dangerous game right now. And
it is a game.
And
it is a game. It's
and kind of hoping rates are going to go the direction that she needs them to go. So, it could be worse than what we're looking at on the page if you take that into account.
Well, and the next 75 years, according to this chart, look very, very peaceful to me. No wars, no famine, no, severe medical issues. Yeah.
Yeah. What you notice from this chart is that our spending is relative. I mean, it's all factored in, right? I mean, you can see how much bigger Medicare and Medicaid are becoming as part of our budget. But the reality is overall spending is relatively flat. What interest is doing, and Medicare and Social Security, involved, those elements are coming together to put extreme strain on all other government spending, right? Think of the pressure that it's putting for all these other government programs that there's simply not going to be the money to fund, unless you're right, unless we're printing dollars, and where that leads, right?
Well, we already are printing dollars effectively by borrowing the money, right? But the political will, as much as the Federal Reserve is supposed to be independent from, congressional, pressure, from executive pressure, but we're going to get to a point where that's probably going to get very cloudy because Congress can't do what it wants to do, what it thinks it needs to do for their constituency if their spending gets crowded out by the interest expense on the debt. And that is what potentially leads to some sort of a falsification of rates, however you want to describe it, where the Fed acquiesces and just keeps rates at a very low level. It's exactly what the Japanese did for many, many years.
So a couple of things I want to just kind of bring us back full circle to the implications of all of this, right? It's incredibly dire. It's not even really comprehensible in terms of just the magnitude of it. But if you like really zoom out and look at the long-term history, like you said earlier, Stephen, you referenced it. I think it was referenced in Larry's book, but the quote about the inevitable outcome of all democracies, in which we all, I think, know historically, have all failed eventually. And the prevailing country or empire whose currency was the dominant currency of the world inevitably also failed and went away as being such. So if you go back and look, and I've actually got a little historical table here going back to the 12th century. You got Venetian ducat for 4 centuries, dominant. Spanish dollar from 16th century to 1800. British pound from early 1800s to 1920. And then basically from 1920 on has been the US dollar. So we're 100 plus years into that, right? If the inevitable outcome of all of this is that, because like you said, there will not be the political will to deal with this. It'll be the most amazing leader ever seen in history that will be needed to try to forge through our government, what really needs to happen to change this. And you've got the interest expense, Social Security and Medicare are the predominant factors, and you're not going to ever change those or take those away. So the inevitable outcome, it seems to be, is that the U.S. Dominance wanes, the dollar loses its influence, and then there's implications from there. So I bring it back to, okay, how does one deal with that environment with so many uncertainties? And does it mean like just give up because it's so bad? And I would propose that what the good news is for us to say in the midst of this whole thing out in the future is, back to your original point, Patrick, way at the beginning, is that's why RBID is, we think, great, because it helps us navigate the crazy landscape that exists, whatever the factors are that are driving it, come what may, and adapt accordingly. Like, for example, the dollar goes down, something else goes up. Well, how do we play in that or benefit from that, et cetera?
Correct. Yeah. And I will say one other thing is that there actually are solutions. There are certainly things that would make this problem less intense, excuse me. But almost think of it as, and we'll get into some of that, but almost think of it as financial chemotherapy, right? Whatever we do to fix a problem, whatever we have to do to fix a problem is going to be really a poisonous medicine, right? It's going to be horrible. But if we want to save what we have, we're all going to feel some financial pain. But at the end of it, right? So I don't want this all to be gloom and doom, because I look at these numbers and I've spent literally over a decade studying them. I do not believe this is the end of the American experiment. What I think we have is that we'll eventually solve the problem. And if you look at the rest of the world and see what bad shape they're in, I mean, most of them are worse shape than us. And we're so dynamic. Our economy is so dynamic. Our federal system is so dynamic. Our government system's as bad as they are. Do you know somebody who's better? And what our model gives us is maybe not the opportunity to thrive in the downside, but certainly to survive it. And if you can survive it, and America does thrive, which I believe this will be a reckoning, right? This will be a correction. a massive correction. But at the other side, if you're the guy sitting on cash or some equivalent of cash, you're the winner. And that's kind of a hard thing to say or to think about. But guys, we're sitting on something that that if we can just survive it, if we can get through it, our clients and our families will be in a fantastic position to survive and thrive.
Sure.
And so that's the whole purpose of this, is to get you to, if we can just explain to people to be prepared, what worked. Like you talk about the bond market, what worked for the last 20 years, the last 30 years. Matter of fact, for my entire career, I personally think bonds quit working 8-9 years ago when the rates got so low and they lost their risk profile, their risk reward profile. But we have the ability to protect investors and to get them ready for what is likely to be somewhere between a Great Recession and a Great Depression. There are economists who are predicting and respected economists who are predicting a 2030s Great Depression. And if you read their book, which I have, Prosperity in the Age of Decline, by the Peter G. Peterson Foundation. I mean, you talk about dire, but there is another side, right? This isn't the end of America. It's just a correction, just a massive one. And if we're ready.
I do think too that we need to make sure that that we're clear with everybody that even though in our minds or the way that we see things, it's hard not to expect some dire consequences, but that we're not trying to fearmonger. We do want to make sure that people recognize that we're trying to have open and honest dialogue around these issues that I think a lot of people are worried about. And we don't know exactly how the market's going to respond to it. We don't know when it's going to happen. But if it does, that we're not just going to sit idly by and watch the market erase years worth of work that our clients have done in saving money and gains that they would have had in the market, and watch it be taken away and not try to really intercept that, move to the sideline, protect what they've got, and knowing that there's always an opportunity to get back in.
Yeah. Well, and on top of that as well, I think one of the things to encourage people with, as you look at this, the serious problem and the projections going forward, is that, again, we don't know exactly how it's all going to play out, but what's great is we can actively, dynamically adapt. And an example of that, when we try to envision what that could be, we're sitting now on like 15 years long of a trend of U.S. stock market outperformance versus the rest of the world. And so an example of how this could play out is if in the future these issues all, percolate to a greater extent to the surface, and the result is the dollar does decline. Well, that could translate into, capital flowing around the world, moving to another part of the world. And while we're here as Americans looking at this from a US centric perspective, it could just simply mean pivoting our viewpoint to allocating more capital outside the US where there's opportunities that could potentially do better. And we've been talking about that on a lot of our, recent, various other discussions and materials we put out, right? That's if you try to get people to envision, well, how could this problem result or translate into opportunity? That's an example.
Yeah, so I'll just read one little excerpt from Larry's book here on this same idea. He refers to it as a great migration of capital, where capital moves from the U.S. heavy growth stocks in those indexes, S&P, NASDAQ, into more value-centric areas. Could be even here domestically, maybe the small caps, but definitely overseas. And he's saying that's really only just begun. We're in the first inning. And as every subsequent rally in the growth space fails, it will bring more disappointment to those investors who are still searching for the promised land and what it's been like over the last decade. One day they will grudgingly pack their bags and they'll walk into the value sector. And so we need to understand, according to Larry, that the future is not growth, it's value. And so that's where the opportunity is going to be, as there are trillions of dollars that get reallocated from where they are now to where they're going to.
That chart I just popped up, right? These projections are determined by a 3.8% baseline interest rate. Each percentage point that interest rate exceed that baseline adds another 35 to 45 trillion dollars in interest cost over the next 3 decades, over the next 30 years. Right. So we just took everything and just made it worse because we're all talking about higher interest rates or devaluing the dollar or whatever the case may be. This just makes it worse. And if you guys really want to get some great charts and some great in-depth economic studies, this guy, Brian, I think it's pronounced Brian Reveille of the Manhattan Institute. The guy's brilliant. I mean, just brilliant, and has some really nice charts. I don't think I've included any of them here. But he's a great source if you really want to understand at an economic level what's happening with the debt. He actually, if you'll read the name of his, he did back in June, he has a solution, right? I mean, he has a comprehensive federal budget plan to avert a debt crisis. So we can avert the debt crisis, in his opinion. What we can't avert, right, or is avoid is pain. We're going to have pain to fix this. It's going to be a massive correction. The question becomes at which level. And I don't want to blame this all on the politicians, right? Because it's not the politicians. It's the voter. It's the Republicans. It's the Democrat voters. I mean, if you try to raise taxes, how many of us in this group are going to vote against that, right? And on the other hand, if you're trying to cut expenses, you got progressives who are going to go up in arms. Well, so what are politicians going to do? If they find a backbone to try to fix this, they only got one term, right? Because they're going to be booted out. And so what happens ultimately is, until we can change the minds of the voter that this is a problem, which is one of the reasons that Chris and I are writing the book, is not just for investors, is that the voters have to change their opinion, because until the voters change how they vote and what they worry about, this isn't going to get fixed. Doesn't matter what Brian says we can do or what the government wants to do. The next round of voters, if we kick out all the people who try to fix it because we don't like the pain, the guys that come back in are going to put us right back on this path. And that's the dilemma.
Right. Well, and that dilemma is only getting worse as you have such a large percentage of the population heavily dependent upon the government right now, even if they have a lot of money. You know, a lot of our clients, they have significant means, but they sure do still love their Social Security checks that come in.
They do.
They don't want to cut them.
No, they don't. So if you cut them, they go after the politicians that did the cut. On the other hand, what Brian says is that, and he's correct, right, is that the baby boomers had a chance to fix it back in the early 2000s. It's when the baby boomers were in their entering their peak earnings years. We could have done something other than just kick the can down the road. But and I'm a baby boomer. I think I'm the only one here who's a baby boomer. So I'll take the hit, right? So we had the opportunity to fix it. We didn't. Now it's the baby boomers that are driving the problem, because there's 76 million baby boomers are all going to hit their final retirement. The last baby boomer turned 65 in 2030. That's the fuse. And that's probably what we should talk about in the next podcast. It's the baby boomers or the fuse. It's either the baby boomers or the interest rate are going to ultimately cause where we have no choice. It either has to be addressed or we get into a debt spiral. Look, I'm not kidding when I say I thoroughly believe that there is an upside to this, right? We've got to have a correction because we're currently broken, right? You wouldn't have Bitcoin. You wouldn't have another country doing the reserve currency. So we're currently broken. But if we just stick with the gloom and doom, you cannot fix this, clients are going to head for the hills. They're going to shove money under a mattress, right? And I don't believe that's the thing to do. And if you go back and you look at the Great Depression, right? You look at the 20s, man, if you got, I mean, you left a lot of money on the table, right? If you missed the 20s, But if you held on till the low, right, you did the buy and hold till the low of the Great Depression, it didn't only just take you 25 years to recover. You lost 29 years worth of growth. Well, guess where that wouldn't have happened? Under our model,
Yep.
right? Because it was a big drop, right? It was 11% drop in one day, 30% drop by the end of the month. But we would have gotten out somewhere down that yield curve, somewhere down that, that loss curve, right? And then if you look at the Great Depression, and the only reason I look at it, it's the only time period that was long enough. Man, there was a lot of opportunity. If you had cash, again, it would have been the money-making opportunity. How would that have fit? You guys tell me. Look at those charts of the Great Depression. Look at those charts of the Great Recession and the dot-com. Look how much opportunity we had to make money when everybody else was getting their head handed to them. And I think that's the point. That's the point of this book, is that if one, I want to bring it down to a level that the average investor can understand. And I think this conversation that we're having is probably well above that, right? But we want to bring it down to a level they can understand and let them know at the end of it, if they're prepared and there's someplace that'll go to cash, there's a safety valve there that our clients can come out on the other side of this in an extremely good place. And so I think we need to talk about that, about what opportunity we're offering, because it is different, and you guys know it's different.
So I definitely want people to walk away from this understanding that while the concepts here are uncomfortable because it's been so good for so long, and nobody wants to think of themselves as being in a place where things are not going well, where it's less good than it is today. That while there are challenges out there, that having the ability to navigate through that, to your point, Patrick, that you can come out on the other side of this smelling like a rose and be better off than you were going into it. That was the case that we saw with COVID, where it upended so many investors. But for our clients, we got to the end of that year and they're looking at statements where they have more money than they ever had, coming through that period of time. And it was by virtue of the fact that they were not invested. The rules-based strategy got them out before the decline, got them back in as the markets had bottomed and were starting to work their way back up. And it wasn't because we were great guessers or that we saw that coming forward, but that the strategy is designed simply to adapt to what market conditions are, what the trends in markets are, and that we believe that if we continue to do that, that we're going to be able to withstand these large drawdowns when they happen and be able to benefit from them on the other side.
Yeah, and that's perfect. I mean, that's what I don't want your podcast, Stephen, to be so scary that people turn it off, right? Because they will. So what you're saying here, I think it's extremely important, because again, this is just going to be another correction. Now, it might be a massive correction, but what are corrections doing? They're fixing problems. They're fixing excess. Well, we have excess debt and we have excess spending and maybe not enough taxes. All of that's got to be fixed at some point. And I believe thoroughly that it will get fixed. The beauty of what this investment team is doing is that you'll be able to take advantage of it when other people are, hopefully metaphorically, jumping out of buildings. Right?
Yeah.
Patrick, it's bad, but really bad, but also bad in our lifetime. I mean, that's the thing that most people, they put this out so far into the future that they don't concern themselves with it. But when you start talking about, dates in 2030, it becomes real quick.
Right.
So,
well, we're talking about 100-year cycle, and we mentioned earlier the roaring 20s, and we're, the last decade has been just incredible. Kind of feels like the roaring 20s again, but what came after that?
mm-hmm.
All right, guys, thank you so much for joining us here for this discussion. I think we've unpacked a lot here today, and this is a very heady topic, a very weighty topic, something that's very uncomfortable even to really have a meaningful conversation about, because when we consider the implications of what we're talking about, it doesn't seem like it could be a rosy outcome or rosy future for us. But we still want to have these conversations, and people want to know that their financial advisors out there are thinking about these things and how it's going to impact their clients. And so I appreciate everybody for joining us here for that discussion. We will continue with a second segment of this where we unpack some more of the opportunities that we think can result from this. But thank you everybody for tuning in. We will see you next time here on Bugle Notes.